If you borrow $100 in the US today, you could be paying as little as 25 cents in interest expenses each year. And the Federal Reserve says rates will remain low until at least 2023, as the government tries to minimize the economic fallout of COVID-19.
We expect to maintain an accommodative stance of monetary policy until these outcomes, including maximum employment, are achieved. With regard to interest rates, we now indicate that we expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time.
The Bank of Japan, the Bank of England, and other major central banks are also holding off on interest rate hikes to spur growth. Access to cheap funds is encouraging people and companies to borrow and invest. But prices of US stocks, gold, and most other assets have already surged. So investors are pouring money into new companies that are entering public markets for the first time. So far this year, 113 companies have raised $38.4 billion on US stock markets. Cloud computing firm Snowflake brought in $3.4 billion on Monday, in the biggest software listing ever. And another 13 companies are expected to attract a further $4 billion through IPOs this week. The bonanza isn't limited to US markets. Stock prices for Indian IT company Happiest Minds more than doubled in its market debut on Wednesday. Online retailer Hut Group saw its shares surge by more than 30% on its first day of trade in London. With 53 IPOs, Brazil is on track to report a record number of new listings this year. And more Chinese firms are selling shares to the public than ever before.
The idea of value investing is taking hold. It is encouraging investors and initial public offerings in China.
Stock markets have been rising at a time when economies are suffering due to COVID-19 lockdowns and increasing trade protectionism. Some analysts say this is a risk for equity markets and could pull down share prices in coming months. But for now, scores of companies around the world are trying to cash in while the market euphoria lasts. Laila Humairah, TRT World.
Well, for more on this, let's go to Art Hogan, who joins us from Boston. He's Chief Market Strategist at National Securities. Welcome back to the program, Art. Now, as we heard there, this is the busiest week for IPOs since 2014. It's the biggest week in terms of planned proceeds since May 2019, when Uber went public. Why is the middle of a pandemic seemingly the hottest time for companies to go public right now?
Well, I can tell you the pandemic's effect on the capital market raising or IPOs and secondaries was one to delay some of that. So from the March time frame and into the early part of the summer, there were really no deals happening until things stabilized a bit. We started to see the reopening process happening. And then as markets lifted off of their lows March 23rd and started to do better, people gradually started walking back in. The calendar also has a whole lot to do with the fact that the last couple of weeks of August historically don't see a great deal of deal volume. So a lot of that gets packed into September. In particular, you've got a presidential election season where everyone wants to get their deals done before you get close to the election, in case there's any sort of election disruption or volatility in the markets. But I will tell you that the main reason for the number of deals that we've seen so far this year and certainly this week is there are so many companies that are able to stay private for a long period of time. Snowflake's a great example of that. Here's a company that started 8 years ago in 2012 and just now is coming public. So historically, back over the last 20 years, companies would come public much sooner, but there's so much money in private equity that's keeping companies private for longer. There's a real hunger for these unicorns to finally come to the public markets, and we're seeing that in spades.
Now, it's not only Wall Street, as we heard, that's really seeing this flurry of IPO activity. We're seeing it over in London, India, Brazil, as we heard in that story. But how much longer do you think these favorable conditions will last?
Well, that depends a lot on when we actually get a vaccine for this COVID-19, right? So I actually think that we're going to have a even more robust IPO market in 2021 if, in fact, we get to the other side of this pandemic. If we actually get a durable vaccine that is broadly available in the first half of next year, I think that releases a lot of economic activity. And we'll probably see even more deals being created next year than we saw this year. And I certainly think the economic growth will be much stronger. So there's still a lot of companies sitting in the private equity hands. We'd love to see them come to the public markets. 2021 probably being better than 20 in terms of the kind of economic activity we see on the other side of this pandemic. And I suspect that this is just the beginning of what's going to be a wave of companies coming out of private land and going into public land.
Now, after the US Fed's latest policy meeting, Chairman Jerome Powell basically said that interest rates in the US would remain at historic lows for the foreseeable future, or at least until maximum employment is achieved. Now, that would normally be music to investors' ears, but we did see a negative market reaction. What more did investors want to hear from him, and are they just being greedy?
No, I think what investors want to hear is something that he brought up, and they want to hear that the gridlock in Washington towards getting fiscal policy out of the Beltway and actually getting a second round of fiscal policy stimulus, a CARES Act 2.0, accomplished is something that we all recognize that we need. So he leaned into the fiscal policy more than the monetary policy in terms of what is needed, and he actually sent out a warning that if not for that, things are going to get worse, not better. So what's happening right now is in Congress, the Democrats and Republicans are sort of digging in on the position and the size of what the next fiscal policy stimulus should look like, and that's frustrating investors. This is a market that had priced in about $1.5 trillion of additional fiscal stimulus, and it just seems to be dead in the water, at least until after the election. So I think that's the frustrating thing and probably what's causing the drawdown on the market over the last couple of days.
And we know in a bit of a twist, Donald Trump has urged the Republicans to increase the size of that proposed stimulus package so the Democrats will come to the table. Art Hogan, we'll have to leave it there, but thank you again for joining us on the program.